Product and period costs are treated very differently for financial statement purposes. Remember what product costs are. These are the same as manufacturing costs as far as external reporting purposes go. All product costs, direct materials, direct labor, and manufacturing overhead, start out in an inventory account on the balance sheet. We'll see what types of inventory accounts in a little bit. They stay on the balance sheet as inventory until the products that they're attached to are sold. Upon sale, the costs come out of the balance sheet and move onto the income statement as the expense account, cost of goods sold. Period costs are non-manufacturing costs. They're expensed as they're incurred on the income statement. They do not become part of cost of goods sold. One difference between the balance sheet of a merchandiser and a manufacturer is the number of inventory accounts that they have. A merchandiser usually just has one account called merchandise inventory, and it holds the cost paid, the dollar amount paid for merchandise. As the merchandiser sells that inventory, it comes out of inventory and it goes to cost of goods sold. A manufacturer has several inventory accounts. Very standard would be these three inventory accounts. Raw materials, which is the cost of materials that haven't been placed into production yet. Work in process, which is the cost of all partially completed goods. And finished goods, which holds the cost of all products that have been completed and are simply waiting to be sold. The income statements also are different depending on whether you have a merchandising company or a manufacturing company. Here's just the cost of goods sold section, and notice they're actually pretty similar. It's just right in here that they're different. For a merchandising company, you start with beginning inventory, add purchases, that's what you paid to buy the inventory. Together, those two things are goods available for sale, cost of goods available for sale, and if from there you subtract the cost of ending inventory, that gives you cost of goods sold. Very similar flow for a manufacturing company. You start with beginning inventory, only you didn't buy your inventory, you manufactured it. So to the cost of beginning finished goods inventory, you add something called cost of goods manufactured, what it cost you to build your product. Together, those two things give you cost of goods available for sale. Cost of goods available for sale minus ending finished goods inventory gives you cost of goods sold. So it's the same basic idea, slightly different terminology, and you have to differentiate what type of inventory account you're talking about. Let's take a look at cost flows and how the various types of costs get accumulated on either the balance sheet as part of an inventory cost or on the income statement as an expense. The amount paid for raw materials initially gets put on the balance sheet in the inventory account, raw materials. Now let's think about the manufacturing process. The raw materials get issued into production. So basically picture a raw materials warehouse or storage room, and some worker wheels out raw materials into the factory area. So raw materials, as they get used, as they get issued into production, become part of a different inventory account, this work in process account. So you've got your raw materials sitting here in the production room. You now need to convert them to your product. To do that, you need to add costs of direct labor and all of the various manufacturing overhead costs. As these costs are incurred, they do not get expensed. They get added to the work in process inventory account. Once the goods are completed, they get moved again. Think of them physically being moved from the factory floor, the production area, to another warehouse, the finished goods warehouse. This inventory account holds the cost of all of the completed inventory. And finally, your finished goods will eventually get sold. As they get sold to customers, the cost is removed from the finished goods inventory account and, at long last, hits the income statement as an expense. Selling and admin costs are also incurred. Those costs never hit the balance sheet at all. Those are period costs. They go straight to the income statement as an expense. Here's a basic summary of inventory flows. And this basic flow chart works for the flow of raw materials, work in process, and finished goods inventory. As you look at the more detailed financial statements, match it up to this basic process, and it will make a lot more sense to you. You'll see all of the similarities. Basically, you take your beginning balance in the inventory account, you increase it for any additions during the accounting period, and that gives you total dollars available. If from your total dollars available, you subtract what moved out of that account, it gives you the ending balance in the inventory account. All right, now we're going to take a closer look at the account titles and how these three inventory flows are linked together. These three inventory flows really are what you use to construct your cost of goods manufactured statement and your cost of goods sold statement. In the raw materials inventory account, beginning inventory is the dollar cost of the raw materials that you had on hand at the end of the last accounting period. You have the same amount on hand at the beginning of the current accounting period. To raw materials, you add the cost of purchases. That gives you the cost of all raw materials available for use. If you subtract what you still have on hand as the cost of raw materials at the end of the accounting period, that will give you raw materials used. The cost of raw materials used is the cost of those materials that are getting wheeled into the production room, wheeled onto the factory floor. The cost of raw materials used comes out of the raw materials account and goes into the work in process account. Work in process also has a beginning inventory amount. These are the goods that weren't completed at the end of the last accounting period. To work in process, you add the cost of direct materials used. Okay, that's different. These are raw materials purchased. We change the name to direct materials once they get put into production. These are direct materials used. We also need to add in the cost of direct labor and the cost of manufacturing overhead. So notice, here's all three of our current manufacturing costs being added into work in process. Together, those things give you the total manufacturing costs in process in that accounting period. Following the same format that we have over here, if we now subtract our ending balance in the work in process inventory account, that gives us a new number. This is where you come up with cost of goods manufactured. This is the cost. This is what it cost you for everything that was completed during this accounting period. This is the cost of completed goods. Cost of goods manufactured then goes into the finished goods computation. Finished goods also starts off with the beginning inventory. You add the inputs, cost of goods manufactured, and that gives you total goods available for sale. We've already seen the layout of this inventory account. If from total goods available for sale you subtract the cost of your ending finished goods inventory, that will give you cost of goods sold. So flowing through these three inventory accounts is how you can compute cost of goods sold. These two inventory flows are considered to be a cost of goods manufactured statement. This column, finished goods, is basically the cost of goods sold statement. They're just rearranged a little bit differently.